Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, we are going to talk about the fact that our equity markets getting disconnected from bonds. And the, the, the markets are showing a very clear trend, divergence in trend. Equity markets are rallying to record highs. Bond yields are still rising. And central banks are still hawkish. Borrowing costs for corporates are still high. So where will this all end? Are equities right? Are bond rights? Or none of them are right? We'll see in this podcast. And at the end of this podcast, you should be investors or financial advisors should be able to take informed decision on what is the asset allocation that should be followed between bonds and equities going ahead. Before that, if you're a financial advisor, the best place for you is INR Bonds Partner Portal, where you can see the best bonds available for investments for your clients. See all the information that is there, including the best price discovery that is available in the market on bond through INR bonds, and to create portfolios or create or take a decision on what bonds to fill in for your clients in their as fixed income asset allocation. Visit INR bonds and log in as partner and see your fixed income assets grow. Yeah. Download Quick Invest app if you are an investor or an advisor looking for a curated list of bonds for the best bonds to invest in the market with the most information and our own risk model with a risk score, which tells you exactly the risk that the bond is carrying for the returns that the investor or you are getting. Download the app, iOS and Android. Back to the podcast. Our equity is getting disconnected from bonds. All just looking at the plains charts show that. So you have the US 10-year closer to 4%. Then you have Fed keeping rates high and talking about more rate hikes. Short-term borrowing costs are still high, and equities are at record highs. In India, we have seen the 10-year GSEC yield come down to 7%, but now it's going back to about 7.2% levels. Borrowing costs are still high for corporates. The cost of borrowing for has been 8%, 9%, or even 10% and 11% and above for many corporates. They've not gone up, but they've not come down either. In fact, we are seeing um, costs actually inching up for corporate borrowers. And the economy is now going on full steam. A lot of with the stock markets at record highs, and if you look at the performance of corporates, all of them are showing very good performance. A lot of capacity creation is happening. Working capital requirements are there. NBFCs are showing very large traction. Bajaj Finance reported very strong growth in numbers for the last quarter. And all this points out to the fact that corporates will have to come to the market to borrow. And if borrowing costs are still high, and if liquidity is still tight, then they would have to borrow at higher costs, and that could eat into their margins. But is that being seen by the equity markets? So, very difficult question to answer. So, in this market, the best way to play this, I would suspect, would be that stick to a very strong asset allocation towards equities and bonds. And if the costs are still high, you'll have to judge whether what is the risk premium that you want to take on equities, and if the bonds are still offering higher returns against and are almost equal to what the risk premium what an equity return can achieve, then asset allocation could change accordingly. Globally, too, the market seemed to have disconnected from global central banks' hawkishness. Most of the central banks are looking to raise rates going forward. RBI too should be following suit. And if that happens, then there would be more short tightness in liquidity as well as rise in short term rates, which again would feed into higher borrowing costs for corporates. difficult to market. So, invest fixed income investors, if you're a financial advisor, look at bonds that are yielding good returns, short term in nature, and there is no rush to get into longer duration bonds. Yields may be stabilizing in a range, specifically up to 3 years of maturity bonds with that reasonably good yields, which can, depending on the risk appetite of the investor or the client, would be the best bonds to look at, or the best portfolios to look at for fixed income. Thank you very much for listening in, and do follow us on all podcast channels.